development of a central bank digital currency. Obviously, at some point, portions of the Federal Reserve have been engaged in that. Is the Federal Reserve still engaged in developing central bank digital currency?
There are parts of the Federal Reserve that continue to be engaged in activities related to global activities on central bank digital currency within the construct of the Bank for International Settlements and our participation in some of their work on innovation.
Does the Fed consider themselves subject to the President's executive order banning central bank digital currency?
We believe that there is no authority, that Congress would have to provide the authority for the central bank to engage, for the Federal Reserve specifically to engage in creation of a central bank digital currency.
Thank you. Comptroller Gould, under President Trump's Fair Access Rule, banks cannot deny services to an entire lawful industry. Has the OCC seen any evidence since January 2025 of national banks continuing to debank crypto firms?
So we're still in the process of going through the complaint data that we've received in accordance with the President's EO. I mean, I'm aware of some anecdotal examples.
Right. Well, I look forward to the report, and you've kind of answered an adjacent question there, but I'll just also add that, and you've alluded to cannabis banking, marijuana banking, but I'd love to submit a question for the record there to see, where the state of play is. Are banks still blocking customers who are engaged in lawful marijuana activities? Because nearly every state, whether you like it or not, has made some form of marijuana lawful in those states, and we haven't synced up at the federal level, so I'd love to catch up on how we're doing that. My time has expired, and I now recognize the gentlewoman from Ohio, Ms. Beatty, who is also the ranking member on the Subcommittee for National Security.
Thank you, Mr. Chairman, and to our ranking member, and more importantly, thank you for being here today. A lot of tough questions that you've had today because we're in tough times. But let me start with following up something that my colleague on the other side, Ann Wagner, alluded to in talking about the some 682,000 cases of check fraud. As we know, fraud and scams are robbing American families of their hardworking savings. It's the number one concern that I'm hearing from banks and credit unions in my 3rd Congressional District. And this summer, I was really pleased to see that the FDIC, the Fed, and OCC issued a request for comments to address the payment and check fraud. So we also know that Congresswoman Maxine Waters' last Congress introduced House Bill 9303, Protecting Consumers from Scam Act. So my question to you, and I'll start with you, Ms. Bowman, and quickly work down to you, Mr. Hill. What are your top line takeaways from the comments submitted, and what target areas are you looking to prioritize? So are there any target areas, yes or no? And if so, give me at least one, and then we can get through.
So yes, this is a critically important issue, and I think some of the most important areas that we should be focusing on is account openings.
Thank you.
Excuse me, one area for us to focus on, again, is the relationship between the largest national banks and payment processing and check refund returns and the community banks.
I will say that Congress passed the Genius Act, and one positive of blockchains, especially public blockchains, is they eliminate some of these issues that can happen with other forms of payment. If you're asking about check fraud, obviously it's been around since we've had checks. And I'm aware that the harm isn't just those who are defrauded. It's the regular credit union member who's saying, why can't you cash my check? Can you just give me the money? It's a certified check. Why don't you give it to me? And it is not their fault nor their credit union's fault why that is the case, why there's a delay. So we try to circulate on our website every new fraud that there is, from romance scams to check fraud.
Mr. Hill.
Thank you, Congresswoman. Fully agree. This is a big and growing problem. We are working very closely with our peer agencies as part of a working group. I fully agree with the comments from Vice Chair Bowman and Comptroller Gould. We are continuing to work through the comments and happy to follow up with more takeaways.
And I'm glad you said follow up, because I would like you to stay in contact. This is very important, I'm sure, to all of us. But in my district, I'm being held accountable for what am I doing. And you're right, it's an age-old thing, but it appears to be more prevalent now that we're seeing this. So I would like to have some contact. I have my legal counsel and financial person, Sierra, here. And so this is something you're going to hear over and over from me. Let me quickly go to the next question. And for you, Acting Chairman Hill and Chairman Bowman and Comptroller Gould, I'd like to start with some questions on cybersecurity. We've addressed that a lot today, and the risks posed by third-party service providers and other technology solutions. As we know, cyber adversaries not only target financial institutions, but also federal regulatory agencies. What are the steps you're taking to enhance the cybersecurity of your agencies and effectively notify financial institutions when there's a breach of confidence and sensitive information that regulators collect from financial institutions? Okay, you want me to pick somebody? Chairman Hill. Okay. And,
I'll be happy to start,
you
since
go.
I certainly raised the issue, and unfortunately the OCC was the victim
Right.
of a data breach that went on for almost 2 years. When we learned of the breach back in February, we engaged extensively with the banks that we supervised to let them know what we were doing, how we were addressing it, what information was exposed. I will say that in addition to bringing on board multiple kind of forensic technical experts to analyze the issue and to make recommendations to ensure that the risk of this happening again is dramatically decreased, I actually turned our own examiners on our agency to examine us as they would a bank to ensure that we had actually made the changes that the third party had recommended, the forensic consultants had recommended.
Unfortunately, my time is up. So do you all agree? Can he be the spokesperson for you all? And if it's a no, you can then get back to me. Okay. Look like you have some friends. They nodded. I yield back.
Thank the gentlewoman. I now recognize the gentleman from South Carolina, Mr. Timmons, for 5 minutes.
Thank you, Mr. Chairman, and thank you to our distinguished witnesses for being here today. I want to begin by commending each of you for your efforts to maintain stability in our financial system in a way that protects consumers, reverses harmful one-size-fits-all policies, and provides much-needed clarity to our community banks and credit unions. This hearing is critically important as we work to ensure that our regulatory framework remains effective, transparent, and responsive to the needs of the institutions and communities it is intended to serve. Vice Chair Bowman, I would like to begin with you. The Federal Reserve's recent finalization of revisions to the large financial institutions ratings framework is viewed by many as a common sense and long overdue improvement. Ensuring that banks are not judged solely on their single lowest component score will create a more accurate and balanced assessment of institutional health. Could you speak to the Federal Reserve's plans to implement this reform and how we should expect it to be faithfully and consistently implemented by examiners?
Thank you for allowing me to provide some additional information and context to our large bank financial rating system. So when the system was initially introduced in 2019, it allowed for a single deficiency. There are 3 categories that it consists of: governance and controls, capital, and liquidity. And the initial framework allowed for a deficiency in one of those categories, not requiring it to be as a financial matter, but any of those categories could determine a bank to be not well managed. As we know, and as we saw in Silicon Valley Bank's failure, banks fail for a number of reasons that are highly predictable and always related to their financial condition. So it's important that we're not artificially judging an institution to not be well managed if we're not reviewing their financial health as a part of that determination.
Thank you for that. Turning now to the need for greater regulatory tailoring, I want to thank you both, Vice Chair Bowman and you, Chair Hill, for supporting efforts to refine our regulatory regime and for advancing the policies that this committee and our colleagues in the Senate have worked on throughout the year. I consistently hear from banks and credit unions in my district that an overly burdensome regulatory framework forces them to divert time and resources away from serving their communities. At the same time, I recognize that limited resources pose challenges not only for financial institutions, but also for the agencies charged with supervising them. Reforming standing policies such as the community bank leverage ratio, along with implementing initiatives like My SMART Act, will strengthen our financial system and allow institutions of all sizes to better support their customers. Chair Hill, as we consider these efforts, how does your agency plan to improve the consistency and clarity of the supervisory process And would legislation such as the SMART Act and the Trust Act help conserve agency resources in a way that ultimately enhances the quality of supervision?
Thank you, Congressman, for the question. So we are engaged in taking a close look at many aspects of our supervisory process, trying to promote more consistency and clarity across the board are key goals that are informing many of the activities that we have underway. The proposed rule we issued with the OCC that would define unsafe or unsound practice and matters requiring attention is partly intended to achieve more consistency across exam teams. Our supervisory appeals process is also, that we've proposed, is also intended to promote more consistency, among other things. And with respect to the legislation, certainly happy to work with you and your office on providing feedback to anything that would be helpful.
Sure, thank you for that. Finally, I want to turn to digital assets. Your agency's plans for implementing Genius and the broader conversation around future market structure legislation. In August, I hosted roundtables in my district with stakeholders from across the financial sector. A consistent theme was the future of crypto legislation and how traditional financial institutions are preparing to participate in this evolving market. These legislative efforts have the potential to reshape our financial system and reduce unnecessary intermediaries. As this work moves forward, it is essential that our financial institutions remain informed and fully equipped to adapt so that they are not left behind. Chair Hauptman, you and I discussed Genius implementation a few months ago, and I would appreciate an update on the NCUA's preparedness. I would also welcome your thoughts on how we can more effectively educate credit unions in South Carolina about the work underway in Washington.
Well, Congress has given us a deadline, I believe, of July 18 next year, and it is my intention to work with my fellow regulators to meet that deadline. Obviously, that's going to be proposed rules and then final rules. We're sitting here on December 2nd and don't have either one of those yet, so obviously between now and July, it's supposed to happen. My guess is the first thing you'll see is, I believe the first rulemaking mentioned, which is how to apply to be an issuer, which for credit unions would be credit union service organizations because they don't have subsidiaries.
Thank you for that. I'm out of time. With that, I yield back. Thanks.
Thank the gentleman. The gentleman from California, Mr. Vargas, who's also the ranking member of the Task Force on Monetary Policy, is now recognized for 5 minutes.
Thank you very much, Mr. Chairman. I want to thank the chairman and also the ranking member, and in particular the ranking member. I think what she said today was not only true, but courageous. It's sad, but I do think we're living through a pretty shameful moment in our history. And I think that is how history is going to see it. And I think a lot of the people that are here today, 10 years from now, are going to see themselves as Liz Cheney's and Adam Kinzinger's, but they weren't. They weren't. We allowed all this corruption to go on, and it's sad. I've been in politics for a long time. I got elected back in 1993. And it's interesting in hearing like this. Normally what happens with politicians, we make a statement, and our statement's pretty political, as mine just was. And then normally we go to the professionals, and the professionals give us information that's very important for us to make decisions. But it's seldom the case that the professionals use the jargon of politicians. And that's been the case most of the time that I've been here. With the exception of today, I was very interested because some of the jargon that was used today, unelected bureaucrats, by the way, that's called professionals. Unelected bureaucrats, the weaponization of finance. All of this jargon is jargon that is used by politicians that shouldn't be used by professionals. And we saw that today, and I think that that's disappointing. Anyway, I wanted to say that because I do see a sliding right now of professionalism in the government, and I think it's sad. And also intellectualism, frankly. I mean, I see today, you know, we're trying to figure out if what we're doing at sea right now is legal or not. You know, it's the equivalent of bayoneting the wounded. When you have survivors on a ship and you hit them again. I mean, clearly war crimes. And this is what happens when we deprofessionalize the government and those that are supposed to carry out the laws. So anyway, I was disappointed in some of the jargon here today, and I'll leave it at that. Now, I do want to turn to climate change. You know, I think climate change is something that's interesting because I've been around again a long time, and it used to be that no one believes in it. Now, a lot of people do. So I'd ask you guys, how many of you believe in climate change? I'll start with you, Mr. Hill, because you're closest to me.
Yes, sir, I do.
You do. When we go down the line?
Climate is changing, that's correct, sir.
Okay, is it, but it is changing. Okay, I won't go into the human aspect, but you do think the climate is changing, yes.
Our view on climate change and natural disasters, which are a risk to financial institutions, is that the local communities are best served to it. Nobody in Florida or Puerto Rico needs me to tell them they have hurricanes.
That's right. Sir?
Whether you call it global warming or climate changing, yes, I understand the climate is changing.
Okay. Vice Chair?
I think climate change climate change is an important policy question, and natural disasters and events happen all the time. I'm from Kansas, so I'm particularly familiar with things like tornadoes and floods.
And yet you guys are pulling back from that information. It seems like that you're not participating like before. Are there no financial risks then? You are the prudential regulators. You don't see risks here in climate change? I mean, you know, you mentioned it. Well, I'm from California, 2 fires. It's interesting, people never talk about Kansas or places where they get hail, because actually hail is some of the largest damage that you see in insurance. It's actually hail. And you're gonna see more and more of that because of climate change. And I think it's gonna affect the mid part of the country significantly. But I think it's a real risk. I think most of humanity thinks it's a real risk, except for us today. Would anyone like to comment on it? Mr. Gould, go ahead, sir.
Oh,
Yes.
May I?
Yeah, please do.
So I think it's not that these events are not risks. It's that they're not more important risks than other risks that banks face. And we believe that banks have been facing these risks. Obviously, I'm a community banker from a mostly rural and agricultural bank, where farmers are the most optimistic people on the planet who have to mitigate and manage to what the weather gives them every year. So they've been managing for these risks for the entirety of the banking system. And it's not that they're not important risks, it's that they're not more important than other material risks.
Okay, we could disagree on the how important it is. But just lastly, I would like to say, I hope you don't slide into this unprofessional jargon. Keep it tight, as they say when we used to play football. Don't slide off and start to speak like politicians. Thanks again. With that, I yield back.
Thank the gentleman. The gentleman from Pennsylvania, Mr. Muser, who's also the chairman of the Oversight and Investigations Subcommittee, is now recognized for 5 minutes.
Thank you, Mr. Chairman, and certainly thank you to all of you. This is very important and worthwhile, so it's appreciated. Comptroller Gould, Vice Chair Bowman, Chair Hill, and Chair Hauptman. Thank you. First, on Basel III Endgame, we need capital rules that strengthen safety and soundness without limiting access to capital for large and small businesses. Second, this committee's debanking report validates our concerns. Last Congress, Biden regulators pressured many banks, were coerced to comply, and lawful Americans lost access to banking services. Mr. Chairman, I ask unanimous consent to enter into the record the majority staff debanking report entitled Operation Choke Point 2.0, Biden's Debanking of Digital Assets.
Without objection.
So I appreciate Comptroller Gould, Vice Chair Bowman, and Acting Chairs Hill's early action regarding debanking by eliminating reputational risk, which our colleague Representative Barr's bill, the FIRM Act, has codified. In order to achieve fair access to banking, the private sector has a role to play as well, of course. Third, financial fraud and scams are rampant, and this committee is committed to a government, private sector, and a whole of society effort to protect consumers, seniors, veterans, young people, small businesses, everyone out there. And that's a top priority for my subcommittee on Oversight and Investigations. So, Vice Chair Bowman, I'd like to start with you, please. You've been very clear on Basel III Endgame, very refreshing, as a matter of fact, that it can have real benefits if calibrated properly for bank lending, especially for community and regional banks. In your view, how can right-sizing capital requirements that primarily affect larger banks help support small business and agricultural lending?
If we're speaking specifically about Basel III, it's important to understand that the approach that we're taking limits the application of Basel III and the required participants to the largest banks. So those requirements would not apply to the smallest banks unless they chose to opt in to that framework.
Okay, let me ask you this then. Do you plan to examine the Tier 1 leverage requirements, the GSIB surcharge, the CCAR requirements as part of your effort to right-size capital?
So we're looking at all the capital framework and the capital pillars in a comprehensive way. We've already worked to address the community bank leverage ratio by setting it at the statutory floor that Congress provided us. I think there are a number of different categories that we're looking at. We'll have a GSIB surcharge proposal. We already introduced the SLR, and the other is the stress testing in addition to Basel III. We're making progress on all of these different capital pillars, and I would definitely tell you that we're not reverse engineering an outcome. Right. We're looking to do risk assessments that would allow for us to set these calibrations according to risk.
Okay, thank you. And to be clear, the Basel III would have greatly destabilized, if you will, our banking community and not helped community banks nor helped larger banks.
In its previous proposals iteration, okay. Yes, I agree.
All right. Comptroller Gould, the debanking report this committee issued yesterday detailed how Biden regulators pressured banks to debank crypto, energy, firearm companies, as well as politically disfavored groups, resurrecting Operation Choke Point that started under Obama. What recommendation do you have for private entities to ensure they have eliminated any internal systems or policies implemented to comply with the Biden-era regulatory pressure?
Well, thank you for the question, Congressman. As I noted before, we're still in the process of reviewing complaints and conducting our review. I would say in general, though, that over-reliance on negative news searches, which is, I think, sometimes a feature of reputation risk, could, again, in an over-reliance situation, be problematic, as well as categorical prohibitions on performing or providing financial services and products to lawful business activities.
Okay, thank you. Chair Hill, the FDIC under previous Chair Grunberg issued pause letters asking banks to cease all activity with crypto companies. What changes have you initiated and have planned for the FDIC to prevent regulatory abuse in the future?
Thank you, Congressman. So first and foremost, we undid the policies of the past few years. So we rescinded the guidance that required prior approval, and we now treat digital asset activities just like any other novel activity where banks are expected to manage the safety and soundness risk, but otherwise have no prohibitions to serving those industries. I think promoting durability of our policies is something that is always a consideration. And so we are considering a number of steps to try to ensure that these types of things won't happen in the future.
Thank you. My time has expired. I yield back, Mr. Chairman.
Gentleman's time has expired. Now my pleasure to recognize the gentleman from Illinois. Mr. Caston, you're recognized for 5 minutes.
Thank you, Mr. Chair, and thank you for the quick bit of exercise from the ranking member. Thank you all for coming. In 2023, former Vice Chair Barr said that the 2023 bank failures caused a reassessment of the viability of uninsured deposits as a funding source across the banking system. 2024, FSOC raised further concerns about some banks' reliance on uninsured deposits, and it could make them more vulnerable to runs. Acting Chair Hill, I think you had raised this concern in your Senate confirmation hearings, and if I'm getting this right, you had specifically said that the FDIC doesn't even have the data necessary on the amount of uninsured deposits above and below the various thresholds other than the $250,000 limit. Without getting into details, I'm curious, in your time in this role, have you directed the FDIC to start trying to get that data?
So I have long believed that more granular deposit data would be useful for a number of purposes.
And just because I'd love to get into what you're doing. I'm just curious if you've initiated any process there or not.
So I would say there have been conversations. I've raised this at the FFIC. That's where most reporting is done through. Okay. But I would say at this stage, I know there's institutions that are collecting data, but we have not taken any steps.
So still important, but haven't done it yet. So the New York Fed recently issued a paper saying that they're noticing deposits are flightier right now, and specifically in response to interest rate changes, finding that there run risks, particularly when rates go up. Wall Street Journal reported recently that wealth management clients are more likely to pull deposits out and chase higher yield when interest rates are rising.
So Vice Chair Bowman, I guess what I'm wondering is the Fed doing anything to monitor what happens if those risks run out of the traditionally regulated financial system to private banks, to other alternative investment vehicles? Are you doing any enhanced review of where that deposit flight might go?
To the extent that we're aware of that, as a part of our work on financial stability, we monitor as much as we can according to the data that we have, and we're able to see the transit of funding throughout the system. I'm not sure that we have specific data about whether it's going from the financial institutions into any particular entities. We don't collect data that would tell us that. We would be able to determine if funds have left the financial system, though, through call report data.
Yeah, and I guess I don't mean leaving the financial system, but we've got this surge of private banking, all sorts of different types of things that are deposit-y, but not within where the FDIC or others would have oversight. And my concern is that if we got a lot of dollars that are in some other part of the system and we're not monitoring it, that is a risk at some point. I'm particularly concerned about how this all affects stablecoins. As Mr. Foster noted, there's a Treasury Department report in April that stablecoin adoption could result in over $6 trillion in deposit outflows. There's a number of other reports that have said that. I guess, Acting Chair Hill, do you all have good data on how stablecoins may affect deposit outflows? Have you started looking at that question?
That is certainly something that we are paying a lot of attention to. I don't think anybody knows what type of impact deposit flows into stablecoins could have on the system. I know there are estimates out there. I think those are basically just guesses.
Well, let me ask a more specific question then, because I think this may answer whether or not there's likely to be deposit flows. There was language that the Senate added to the Genius Act that I think creates a huge problem for your agency. It says that the claims of a customer with respect to payment stablecoins shall have priority over the claims of any other person other than the claims of another customer with respect to payment stablecoins. So if there's a bank run and you have customers of stablecoins with deposits in a bank that are not insured, that language would suggest that they have a senior claim. Have you made any effort to interpret that language? How are you going to deal with the conflict if we get in a situation like we got to in 2023 when Circle's deposits were sitting there in uninsured accounts and there was a run? Should a stablecoin depositor assume that you are going to place that customer in a senior position to insured depositors?
I would have to go back and look at the statute to make sure I'm correctly understanding it, but my understanding is that language is applicable if the stablecoin issuer fails, not if a bank fails. And so from our perspective, we would still have our normal authorities, our normal priority in the case of a bank failure. That's just the provisions that would apply to a bankruptcy proceeding if a stablecoin issuer fails.
Well, we could use some clarity, particularly as the chair ranking member had noted, there's some shadiness as far as who is making these deposits.
I thank the gentleman. Your time has expired. The gentleman from Texas, the chairman of the House Small Business Committee, Mr. Williams, you're recognized for 5 minutes.
Thank you, Mr. Chairman, and good to see all of you today. Thank you for being here. The previous Basel III Endgame proposal would have substantially raised capital requirements for an already well-capitalized banking industry. One of my main concerns with the previous proposal was the negative effects these requirements would have on small business lending. Under the provision proposal, credit would have become more expensive and harder for Main Street businesses to secure. And as you continue your work on the Basel III Endgame proposal, I urge you to ensure the revised framework avoids imposing unnecessary burdens to restrict Main Street America. So Vice Chairman Bowman, could you elaborate on how the Fed will ensure any changes to the capital levels will not disrupt the flow of capital to Main Street businesses?
Thank you for that question and the opportunity to clarify the work that we're doing around Basel III. I think it's very important as we're working toward reviewing the capital framework that we're not disincentivizing providing lending or other types of activities to those businesses that make our economy run. The purpose of the work that we're doing is to ensure that the banking system can support the economy in a way that allows the United States to continue to be the economic powerhouse that we are.
Okay, thank you. Chairman Hill and members of the committee, myself included, sent a letter to the Fed, OCC, and FDIC urging you to take a closer look at how enhanced prudential standards are being applied across Category 2, 3, and 4 banks and to update static thresholds so that supervision reflects actual risk rather than outdated asset lines. And these EPS thresholds were set in 2019 and have not been increased since then, even though the agency said they would evaluate them regularly through notice and comment. Not indexing these thresholds has created an artificial constraint on banking activity that hurts the economy across the country and in districts like mine back in Texas. So will each of you, the Fed, the OCC, and the FDIC commit to working on an interagency basis to index these EPS thresholds? When could that happen, do you think?
Yes, we will commit to reviewing our thresholds and indexing them.
Enhanced prudential standards are the purview of the Fed as they apply at the bank holding company level, but we are doing similar things at the national bank subsidiary level as well.
And likewise, happy to commit to reevaluating and indexing thresholds where appropriate.
Okay, all right, thank you. This committee has held several hearings examining the concerning trend of consolidation in the banking sector. The federal regulators' response to March 2023 failures muddied the waters on statutory functions such as the least cost resolution mandate. Acting Chair Hill, how can Congress enhance the FDIC's resolution process, such as by providing greater flexibility to the least cost mandate in order to promote a greater transparency and competition?
Thank you for the question, Congressman. I think allowing additional flexibility under the least cost would be useful in certain circumstances. There are a variety of possible situations where the FDIC may have two resolution options that are very similar in cost, but there are significant benefits to one or the other. Today, there is essentially no discretion, and so it needs to be a mechanical choice to choose the least cost resolution option. I think Congress would still want to ensure that there was discipline around any flexibility to ensure that cost still remained a primary consideration. But I do think there are situations where having at least a little bit of additional flexibility would be useful.
I've got limited time, but one more question, Chairman. How might a more strict set of conditions to waive the national deposit cap for the acquisition of a failing or failed bank help reverse the trend of consolidation in the banking sector?
Certainly a lot of considerations there, but as I'm sure you're aware, today there is an exception to the caps in the event of a failed bank acquisition. I know there's legislation in place that would potentially allow some more flexibility in those types of situations. Again, I think from my perspective, at a broader, more holistic level, I think having a little bit of additional flexibility around least costs would be useful.
Well, again, thank you all for being here. Appreciate the testimony, and I yield back my time.
Gentleman yields back. Gentleman from New York, Mr. Torres, you're recognized for 5 minutes.
Thank you, Mr. Chair. I have a question about the intersection of the financial system and AI. Private credit, banking, insurance, and AI CapEx are becoming increasingly interconnected. The AI sector is experiencing the largest capital boom since the railroads of the late 19th century, and AI CapEx has become a disproportionate driver of both economic growth and equity market performance. To what extent do you view the entanglement of private credit, banking, insurance, and multi-trillion-dollar AI CapEx as a potential source of systemic risk? I'll start with the Fed.
Well, thank you. As the entity responsible for financial stability in the financial sector, it's a very important question that you've just raised. And it's something that we've been watching very closely to see how the AI industry and its investment has been evolving. We've seen an increase in asset levels and their valuations over time, and it's something that we continue to watch, and we're definitely paying close attention.
So is that a yes? Do you view it as a potential source of systemic risk? Or?
Well, it's certainly one of the risks that we're looking at.
I have a question about the independence of regulatory agencies, and I'll start with the Fed. Do you see your regulatory agency as independent of the president or as a creature of the president?
The Federal Reserve is an independent, apolitical agency, and as long as we continue to be transparent in the work that we do and we're accountable to Congress and the public, I think that that should continue.
What about the FDIC?
The FDIC is defined by statute as an independent regulatory agency, but we have also always tried to coordinate our activities with other agencies throughout the government, and so that's something we continue.
But independent, okay. And Kua?
Statute says that NCUA is an independent agency within the executive branch. One way you could describe our independence is we're obviously not on budget. The shutdown did not affect us. We are not funded via appropriations. That is one degree right there of independence. But again, I concur with my colleagues. We've always coordinated with the White House, and they've been a big help this time.
The Comptroller, during your testimony, you spoke of your opposition to, quote, the weaponization of finance, which is a sentiment I share. We've seen President Trump publicly order the Attorney General to prosecute political adversaries. If the president were to order you to weaponize finance against those same political adversaries, what would you tell him? Would you tell him, no, Mr. President, the OCC has an absolute policy against the weaponization of finance?
Congressman, thanks for the question. I'm not going to engage in hypotheticals. What the president has told me through an executive order.
Do you have an absolute policy against the weaponization of finance?
Excuse me?
Do you have an absolute policy against the weaponization of finance?
There's a presidential executive order that says that banks should not discriminate on the basis of politics, religion, or being engaged in a lawful business activity.
Capital requirements. If capital requirements were at 0%, there would be no safety and soundness. If capital requirements were at 100%, there would be no capital formation. And so the object of public policy is to find the best balance between the two, to find the Goldilocks level of capital requirements. Like, what is that Goldilocks level, and how do you determine that level empirically? And I feel I have not heard a satisfactory answer to that question from either side of the debate. Your predecessor insists that the system is undercapitalized. You seem to believe it's sufficiently capitalized. Like, what's the objective empirical standard against which those competing pronouncements are being made?
The statute's direct definition for different sizes of banks is well capitalized. So that's one measure that we can use. We can also look back at the capitalization of the banking system prior to the great financial crisis in the aughts and determine that clearly was not the right level of capital in the system. So the work that was done as a result of Dodd-Frank clearly improved the levels of capital and liquidity within the banking system. It more than doubled the levels of capital, and liquidity is very strong.
Is there a specific number?
I don't know that we know a specific number, but we are working to achieve a review of our capital requirements in a way that allows us to assess the risk that certain activities present to the financial system or the banking system.
And I want to quickly ask about, there's been public reporting that the Federal Reserve is planning to cut Supervision and Regulation Division by 30%. As you know, the story of SVB was partly a story of supervisory failure. If my constituents were to ask me, Congressman, why on earth is the Federal Reserve cutting supervision by 30% following the supervisory failures surrounding SVB, what should I tell them?
Well, Congressman, that is an excellent question, and I really appreciate the opportunity to clarify that. So when we're talking about reorganizing, we're talking about the staff at the board. Before the financial crisis, we had about 200-ish employees at the board. None of them are actual supervisors. They coordinate the activities of those supervisors that are resident within our 12 reserve banks. We're not talking about what we're doing with those supervisors, so they're completely separate.
Gentleman's time has expired.
Thank you, Mr. Chair.
I'd love to provide you with more detailed information on our reorganization. Thank you.
The gentleman from California, the chair of our subcommittee on Asia Pacific in the House Foreign Affairs Committee, Ms. Kim, you're recognized for 5 minutes.
Thank you, Chairman and Ranking Members. Maxine Waters, thank you so much for hosting today's hearing, and I want to thank all of our witnesses for joining us today. Good to see you. Community banks across California have relied upon the community bank leverage ratio to lower their regulatory burden and invest more capital in the communities around them. As you know, I recently introduced the Community Bank Lift Act that would review and reform the components of the leverage ratio and lower the bands of the ratio. And it is for that reason I was really pleased to see the recent announcement from the Federal Reserve regarding a proposal to lower the CBLR from 9% down to 8%. So I want to ask you, Vice Chairwoman Bowman, at the current threshold of 9%, how does the CBLR framework's regulatory burden compare to the generally applicable risk-based framework?
So at 9%, it's about the same, double the regular or the well-capitalized requirement within the statutory requirements. So we're also, by using the 8% that was allowed in the 2155 and the creation of the CBLR, we continue to be around the level of double the well-capitalized.
Thank you. I
level.
look forward to continuing to work together and, on the Community Bank Lift Act and create the regulatory flexibility that community banks need to better serve our communities. But I want to shift away from the community banks and focus on the U.S. operations on foreign banks. So continuing on our conversation with you, Vice Chair Bowman, as you work on amending the regulatory and supervisory process for U.S. banks, I want to ensure that you are also applying those changes to the U.S. operations of foreign banks as well. So can I get your commitment to the principles of national treatment and level playing field as you contemplate the changes to the regulatory process and supervision of foreign banks in the United States?
It's absolutely appropriate for us to ensure that there's a playing field for foreign banks and their participation in the U.S. economy and in economic activity and serving customers in the United States. This is certainly something that we will continue to keep in mind as we're reviewing our capital framework and the regulatory framework more broadly.
Thank you. As you know, while those banks are headquartered internationally, they employ tens of thousands of Americans and have been essential to financing the U.S. economy. So thank you for keeping that in mind as you contemplate those changes. In Southern California, where I represent, we're blessed not only to have a strong community banking organizations, but also great credit unions as well. Having said that, I am concerned about the tools that are available to smaller credit unions in the event of a liquidity crisis. So I want to ask the next question to Chairman Hauptman. Right now, some associate credit unions lack access to the Central Liquidity Facility, CLF. What are some of the barriers that credit unions face in accessing that CLF, and how can we ensure that more credit unions have access to CLF?
Yeah. I appreciate you bringing that up, Congresswoman. Liquidity is obviously crucial for every financial institution. We examine for it. It's the L in CAMELS. And if a liquidity crisis, if you could see it coming, it wouldn't be called a crisis. Vast majority of credit unions, over 3,000, are below 250 million in assets. Right. For the small ones, the median number of employees is 1. How do you get there? Because there's a lot that have 0, like church credit unions, where their employees are employees at a church. For a period of time there, Congress allowed the corporate credit unions to serve as an agent when there's a liquidity crisis. That authorization has lapsed. We have done everything we can to make that applying for our central liquidity facility, made it easier to find on our website. It's only 12 pages. We promote it. How easy it is to do. That said, the reality is most of the small credit unions do not have access to it. They haven't gotten around to it for a variety of reasons. And for a period of time, they were allowed to use their corporate credit union as an agent in a liquidity crisis.
Thank you. I'd like to put in the last question. And in the communities I represent, there are new digital banks along with community banks and credit unions. And the ones providing fair and affordable financial services to small businesses and working families. So I want to ask you, Comptroller Gould, as you evaluate changes in supervisory and capital expectations, will the changes also apply to banks with the same asset threshold that focus on novel tech-driven businesses?
If I could ask the Comptroller to respond in writing to the gentlewoman from California.
I have time.
You're overtime, I'm sorry to say. A gentleman yields back. The gentlewoman from Texas, Ms. Garcia, you're recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you for all the witnesses for joining us today. I'm glad we got to sneak this hearing in before the end of the year. For a second there, I was worried we would go through the whole year without hearing from our regulators, so welcome. Similarly, this committee has not yet had the opportunity to hear from the acting director of the Consumer Financial Protection Bureau, CFPB, despite the statutorily mandated semi-annual report to Congress. So since I can't ask Director Vogt, I will ask Vice Chair Bowman, in the absence of the CFPB, do you know if anyone at all, is supervising and examining the largest banks in the nation for compliance with federal consumer protection laws?
Well, thank you for that question. I too value the importance of consumer compliance, regulation and enforcement and supervision. I oversaw that capability at the Federal Reserve for the first 6 years that I was on the board. We do have a responsibility at the Federal Reserve for
The question is, do you know of anyone that's actually doing it?
We are at the Federal Reserve. We have responsibilities for a narrow set of consumer compliance regulations for all sizes of institutions that are state member banks.
Are you aware of anyone else that has taken on the role of doing this?
I believe that the other regulators have the responsibility in that narrow context as well.
So, Mr. Gould, is that true?
Thank you for the question, Congresswoman. The OCC's approach to consumer protection has not changed, but as you know, under the Dodd-Frank Act and specifically Title 10, the Consumer Financial Protection Act, the CFPB has certain exclusive authorities, such as supervision authority for banks with more than $10 billion in assets.
So, but the question was, do you know if anyone that is actually doing the work of supervising and examining the largest banks?
Again, Congresswoman, the OCC's approach to consumer protection has not changed, so we continue to have enforcement authority, but we do not have supervision authority because Congress stripped us of having supervision authority in Dodd-Frank.
And Mr. Hauptman?
Just to make sure I get this right, mind repeating what you're asking?
I'll repeat the question. Since I can't ask Director Vogt, in the absence of the CFPB, do you know if anyone is supervising and examining the largest banks in the nation for compliance with federal consumer protection laws? And in response, Ms. Bowman said that they had some supervisory review and that all the others do, which is why I'm asking each one of you now.
I got you. All right, yeah. I would have got it right the first time, but I'm glad you repeated that. Less than 0.5% of credit unions are over the 10 billion threshold. Out of 4,300, I believe there are about 20 that the CFPB was on site. So all things considered, what the CFPB does or does not do is less of an issue for credit unions, just given their size, but we are continuing to enforce the law.
Then your answer is no.
I mean, are we examining that?
So you're not looking at it because it's way above the threshold that credit unions.
My point is that less than 0.5% of credit unions were examined by the CFPB in the first place. I'm just trying to get my hands around the scale of the issue here, but we are certainly enforcing
It's all right, then I'll move on, Mr.
every
Hill.
consumer law.
Similar to my colleagues, we do have authority over certain consumer protection laws for the largest institutions that we supervise, and so we continue to fulfill those statutory obligations.
But you're not aware if anyone else has taken the role that CFPB specifically had?
That's correct.
All right. So then I'll move on. Earlier this year, the agency's president state jointly issued a proposal to rescind the Community Reinvestment Act, the CRA. Because of ongoing legal challenges, the agencies are applying the 1995 regulations to the banks today. It is now 2025. 30 years have passed, and with it came innovations and changes to the banking industry. Acting Chair Hill, do you think that the 1995 regulations are well suited to take into account modern online and mobile banking?
I think there are a number of reasons why the 1995 rule has challenges with it. We currently have issued a proposal.
So your answer is no?
I think modernizing CRA is something that is worth considering doing. I voted against the 2023 rule and thought it had a lot of flaws, and so I think...
So do you have any plans now to do that, or among your cohorts here?
We have a proposal that is currently pending. We are reviewing the comments to that proposal, And so I think it's premature to say what our next step is. But I think reverting back to the 1995 rule is a better option than the 2023 rule that had been put in place that has never actually gone into effect.
I see my time is up. Mr. Chairman, I may submit my last question for the record and ask all the witnesses to respond.
Sure, I'm sure they will. I thank the gentlewoman. Now it's my pleasure to recognize the gentleman from Wisconsin, Mr. Stile, who serves as the chairman of the Digital Assets, Financial Technology, and Artificial Intelligence Subcommittee for 5 minutes.
Thank you very much, Mr. Chairman, and for holding today's very important oversight hearing. I want to start with you, if I can, Ms. Bowman. You were asked by my colleague from New York about your supervisory reform plans. You ran out of time to be able to comment on that. Could you just briefly provide a little insight as to what your reform plans are?
Absolutely. Thank you for the opportunity to clarify that. So at the time of the financial crisis, we had around 200-ish employees at the board. That grew by 76% up until the current state today, where we had 500 authorized positions. Our work to, obviously, the addition of all of those supervisors didn't help us with our focus on ensuring that banks' safety and soundness has been secured, as we saw by the failure of Silicon Valley Bank and some of the other banks that failed around that time. The way that we ensure that we're providing safety and soundness is to focus on financial risks. So the work that we're doing now to reorganize our division will allow us to better align our work with those risks that lead to banks' failures.
Appreciate this. So it's better alignment in resourcing people onto the risks that we face. Let me shift gears completely, but stay with you if I can, Ms. Bowman. As you likely know, the Basel Committee applies a punitively high-risk weight for digital assets. Out of this committee, we passed the Genius Act, passing into law. I want to come over to how we're doing on the regulatory side in a minute. But the chair of the Basel Committee recently said that a, quote, different approach would be needed to address the mismatch between current Basel capital treatment and the reality we see in the crypto industry. Bank of England declined to use this. Can you comment with how you're going to work within this Basel framework, or whether or not you view it as unnecessarily punitive as well?
Well, I can confirm that I believe that the risk weights that were initially assigned prior to my joining the Basel Committee and the GHOS role is that was an over-calibration of the risk. So my hope is that there will be a recalibration of it at some point, or we won't join in adopting that framework.
Appreciate your comments. I'm going to come to you, if I can, Mr. Hauptman. We passed the Genius Act, first regulatory bill of substance in the crypto space. We got a huge opportunity with clarity in front of us. You have a big role on the regulatory side. Can you give us an update as to where we're at on the regulations moving forward in the Genius Act briefly?
Yeah, I think stablecoins are an absolute game changer. This country, as advanced as we are with the biggest internet companies in the world, our payment system is very creaky. There are countries we give foreign aid to that you can settle 24 hours a day, 7 days a week.
So the faster we get this done, the better we're going to be. Where are we at on the regulators?
You gave us a deadline of July 18. I believe I and my fellow regulators are committed to doing that. My guess is the first rulemaking you'll see will be the one on how to apply to be an issuer, but your constituents should benefit by having 7-day-a-week payment, which, as you know, is difficult in this country.
Are you committed?
Yes.
I'm just coming to the time.
Yeah.
I'm fully with you on Genius. Is why we did it here. I just want to make sure that we get these
fully
regs
committed. Yes,
done on time. You're fully committed, and you believe you are in position to deliver on that commitment.
Yes, I think myself and fellow regulators, and I want to give credit to the Secretary Besant for making sure that Treasury is helping to convene that. I think we're on track.
Thank you. I think that's just really important. We've seen instances across years in this committee where sometimes bills are passed. We don't see the regulations come out on time. I appreciate your commitment to delivering on that. I want to stay with you for a second. And we've done a lot of work here looking back at Choke Point 2.0. And in particular, how the broader crypto and digital asset space was being governed by enforcement actions, incredibly unproductive mechanism to do that. I think we have a huge opportunity here to move forward clarity to prevent the type of abuse we saw with Chairman Gensler and with other regulators in the broader Biden administration. How important is clarity being done to help guide you and those on your staff to be able to follow congressional intent rather than engage in enforcement actions to drive forward policy.
Well, regulation by enforcement, in my opinion, is unethical. There's not one person in this room that would tolerate it in any other part of our life. There has to be a speed limit first and then a speeding ticket after that. I'm proud that we now have its actual NCUA policy. A future board can change it if they want to, but they'd have to explain why they pulled down our regulation by enforcement policy, simply defined as no enforcement ever sets policy. And the same protections.
Will the Clarity Act help you on that?
I don't want to comment on certain that, but you shouldn't have any enforcement that ever sets policy.
Very good. Appreciate all of you being here, Mr. Chairman. I yield back.
The gentleman yields back. Gentleman from California, Mr. Liccardo, you're recognized for 5 minutes.
Thank you, Chairman. Vice Chair Bowman, I understand that Governor Waller recently previewed that Federal Reserve is exploring the creation through rulemaking of a new, what he called a skinny master account for eligible fintech institutions to be able to access the Fed's payment rails. And the target was to do so by the end of 2026. We've heard similar suggestions from Undersecretary Lang of Treasury. I've heard, I think we've seen from Acting Comptroller Sue, suggestion that it should be up to Congress. At least it's not going to be in her regulatory, or his rather, regulatory role. My question for you, do you support expanded access to payment rails for non-bank institutions?
We have currently a construct for the approval of different varieties of institutions with different risk categories. The third category does apply to non-depository institutions, and there are certain parameters around those that decision framework. So it's whether I agree with it or not, it's policy of the Federal Reserve that's part of our master account application review framework.
Okay, as you know, there is a concern from many fintech companies about access to the FedNow rail, and their ability to do so without having to essentially contract with or partner with a bank. At this point, you are saying the Federal Reserve is moving forward and you are supportive of regulations to make that happen.
What I'm saying is I support exploring that opportunity, but we do have a framework that's currently in place that does allow for access for institutions that are not depository institutions to be considered for an application now.
Okay. Given what you have said, you believe it is important for Congress to offer any clarification through statute to ensure there is a clear path, or do you believe this is something that can be handled entirely within the Fed's regulatory ambit?
I'm not familiar enough with the authorities to understand whether or not we would need specific additional authorities to do that. So I'm sorry, I can't okay. Comment on that.
If I can shift a little bit to stablecoin, I think both for you and for Chair Hill, I supported the Genius Act. I was proud to be an original co-sponsor of the House version that both Chair Hill and Chair Stile had authored. And I think it's important to set clear regulatory guardrails for stablecoin. I understand you all have roles to write and enforce regulations that will integrate stablecoin into banking in a way that's consistent with a sensible regulatory framework that prioritizes safety and soundness of depository institutions that you regulate. Under the current Genius Act, it ensures that stablecoin issuers will have reserves in safe assets. It lists what those assets are, their deposits, their treasuries, the demand currency, et cetera. And the notion is that the valuations won't fluctuate much. And I assume you support having relatively safe assets serving that role in reserves. Is that fair? I guess starting with Vice Chair Bowman.
I think it would be helpful for me to understand what you mean by reserves. Are you meaning stablecoin reserves, or could you clarify that for me?
Stablecoin reserves, yes.
So I think Congress has given a range of options for stablecoin issuers to use as potential reserves. So yes, it would be important that they are stable, auditable, and immediately accessible for whatever regulatory framework that we would create.
Okay, given the time, I'll just move quickly here. Given our shared goals of safety and soundness for financial institutions, would it make any sense to allow stablecoin to be backed by commodities, either Vice Chair Bowman or Chair Hill. That is for a reserve to be commodities.
I mean, my recollection is the Genius Act is fairly prescriptive in what qualifies as eligible reserves, and to my recollection, I don't believe there are commodities that would qualify.
I agree with you, because the question is, would it be sensible to expand in that way?
I think that's a decision for Congress to decide.
Does it seem consistent with safety and soundness concerns that you obviously have in your everyday regulation?
Yeah, I mean, I think it would be a different model. I mean, Congress set up a model where stablecoins are backed by super safe reserves. One could imagine different models where potentially there were different types of reserves, but then you might have other mitigating factors as part of the regulatory framework.
And wouldn't you be concerned about runs? I understand I'm out of time.
The gentleman's time has expired. Now yield myself 5 minutes. So first of all, I want to thank you all for being here. It's refreshing to have regulators in place that once again care about legitimate safety and soundness issues rather than advancing political agendas. So I appreciate that. I represent one of the most rural congressional districts. I have some very large counties that have less than 500 people in them. Actually, we have more cows than people in my district. And it's our community financial institutions that make sure that my constituents, particularly in cow country, have access to banking services. So I'm going to just go down the line on this one. This question's for each of you. So what is the biggest regulatory barrier you see facing rural financial institutions, and what is your agency doing to address it? And I'll start with Vice Chair Bowman.
Thank you for being from a rural community very similar to yours, where we have more cattle and likely deer than people. I think it's very important, and having been a community banker in that community, the importance of right-sizing the regulatory burden is absolutely critical for smaller institutions to be able to continue to serve their communities.
Thank you. Mr. Gould?
I agree with that. I think it's the over-regulation and over-supervision. One of the things that was occurring at the OCC too frequently when I took over in mid-July, and what that had occurred over the last 4 years, was a situation in which we were not actually engaged in risk-based supervision. So we were subjecting smaller banks to prescriptive requirements coming out of DC, which made no sense based on their business model.
Thank you. Mr. Hauptman?
I'm from a remote area as well. It was 26 miles to get to a McDonald's. So I hear you on that, and our local community institutions served an invaluable role that none of the big banks would. I would say BSA AML is the thing I hear over and over again. Every retiring executive who leaves it and says, what are you not gonna miss? They're gonna miss a lot of things by running credit union. The thing they're not gonna miss, you hear it over and over, BSA AML. They say it's not the time I spend on it, it's the time I waste on it. That's one area where I think we could work together.
Thank you. Mr. Hill?
Yeah, I would echo all the comments from my colleagues. I'd say the two things that I hear most frequently from the smallest institutions are the cost of compliance and the cost of technology adoption. And we are taking a number of steps to try to make progress in those areas. On the compliance side, that includes things like reforms we're making to supervision. We recently just finalized a rule that would raise and index several dozen thresholds, almost all of which apply to community banks. Fully agree with the comments on BSA, AML, and we're heavily engaged with conversation with the Treasury Department and others on reforms to that process.
Thank you. Thank you all. Shifting gears here, the Financial Services Committee released a staff report yesterday on the Biden administration's efforts to debank digital assets. This question is for anyone who wants to answer, but what lessons is your agency taking from this report, and how are those lessons shaping the agency's broader approach to digital asset policy, including implementation of the Genius Act? Any takers, Mr. Gould?
I think one takeaway for me, at least, is that if the activity is legally permissible, which the Genius Act just made payment stablecoins legally permissible, as well as, for example, the custody of digital assets that's legally permissible, I think it's really incumbent upon the supervisors, so us, OCC, to work with the banks that want to engage in these legally permissible activities and ensure that they can do so in a safe and sound manner. That is, not put all the burden on the banks to come up with how to do it in a safe and sound manner. That's what we saw over the last 4 years. And that was essentially the death knell for those activities that, again, were legally permissible and some banks wanted to engage in. But if the regulators won't work with them to find a path to do it in a safe and sound manner, there's no way they can do it.
Right. Thank you. Anyone else? Mr. Hauptman?
I'll just add that under the prior administration, I've been at NCUA for 5 years. I was confirmed 5 years ago today. I'm proud that working with my Democratic chair at the time under the Biden administration, NCUA was the only regulator that I'm aware of that not only was not hostile to digital assets, that caused some of the debanking, but we put out positive guidance, 2 pieces, which is 2 more than anybody else put out during that time. And credit unions saw the other result of the debanking. They got an enormous amount of attention and deposit flow from digital assets firms. Why? Because they were afraid of being debanked by the banks, which is where they had their money. I just want to add that.
Thank you. Any follow-up? Well, my time has expired. I want to thank you all for your comments there. So now the gentlewoman from Michigan, Ms. Tlaib, is now recognized for 5 minutes.
Thank you so much, Chairman. As you probably, all of you, I don't know if in October, the FDIC and OCC and Fed withdrew their interagency principles for managing climate-related financial risk. Are you all aware of that?
Yes.
Yes. Yes.
Okay, nodding. The associated framework required banks with over $100 billion in assets to consider climate-related financial risks and business strategy, risk management, and strategic planning. The agencies claimed that the principles are unnecessary because the agency's existing safety and soundness standards are adequate. But climate-related financial risk is unique. We all know that. The scale of potential impacts, I've seen it all alone in my own district, the complexity of the climate system, the existence of multiple positive feedback loops, the long time horizons on which climate change operates are all singular. So Vice Chair Bowman, can you explain how existing safety and soundness standards will adequately capture the unique features of climate risk, take the potential impact of climate systems, multiple tipping points, for example, whose precise thresholds are uncertain, it's just can't really predict this, and which may lead to runaway changes that cannot be reversed.
Well, it's important to note that banks are not climate scientists and they don't make predictions about what the climate will hold, but they do and have for since the dawn of time, or as long as banks have existed, understood how to manage risks from the environment and from natural disasters. I'm from Kansas, a neighbor to your state. We frequently experience natural disasters, and also agriculture is a common business service that's provided for lending. From banks.
I mean, some of
they
them
know how to
though,
manage, but they know how to manage these risks. And in the aggregate, climate doesn't present a more material risk across the board than any other risk that banks face. And they know how to manage these risks. So it doesn't make sense.
What do you take with the Fed memo? In the memo, it actually says that the principles may be, quote, distracting firms from the management of material financial risks. This implies that climate-related financial risks are not material. I mean, Vice Chair, do you believe climate-related risks are not material?
I wouldn't say that they're not material. What I would say is that they're not more important than other risks that banks face, and banks regularly manage their risks.
Dozens of billion-dollar climate disasters each year, correct?
I don't know.
It's dozens of billion-dollar climate disasters happen each year, which destroy property and wipe out assets. Are no interest to investors?
Well, it certainly isn't that there's no interest. It's just that the risk that's posed by these events isn't more material than other risks that banks face.
So 10 years ago, former Bank of England Governor Mark Carney gave a speech titled, it's a very good speech, I recommend you all, Breaking the Tragedy of the Horizon. In that speech, Carney noted a unique challenge for regulators. He said that through the impacts of climate change will be most devastating in the future. Action to minimize those impacts is required right now. And Carney said, quote, "One, climate change becomes a defining issue for financial stability, and it may already be too late." Vice Chair Bowman, do you agree with that quote above? And
I don't agree with that quote. No, I think it overestimates.
then would
the
you
risk of
determine if climate change poses a threat to financial stability or to the banking system? So climate risk is no risk to the financial system.
That's clearly not what I've said in this conversation. Clearly,
So you don't believe in what Carney's saying?
I do not agree with what Carney says, no.
But
He's
you
a-
believe
he's
that climate
currently
risk is a
politician in Canada, so
Yeah.
it's hard to.
I know,
take
Vice
advice
Chair.
from a
I think for me, it's the
politician.
threat to financial stability and the fact that we do nothing about it right now.
I would not say we do nothing about it.
But we have dozens of billion-dollar climate disasters right now.
But banks do manage the risks that are posed by climate events.
I think they're just waiting for us to bail them out each time. Earlier this year, Chair Powell testified at the Senate Banking Committee hearing that due to climate change, quote, if you fast forward to 10, 15 years, there will be regions of the country where you can't get a mortgage, okay? There won't be ATMs or banks won't have branches or anything like that. Vice Chair, do you believe the Fed need to wait for such impacts before taking action? Because I think in some places, some people can't even get insurance right now.
The Federal Reserve is not an insurance regulator. The states are the regulators for.
So the feds will bail out the states.
Insurance industry. So those risks in that policy is the determination of the state commissioners.
So we're going to
and they're
wait till all this
overseeing
happens.
that.
We don't really want to consider it.
It's not the Fed's remit.
I know, okay. All right, thank you.
The gentlewoman's time has expired. The gentleman from Indiana, Mr. Stutzman, is now recognized for 5 minutes.
Thank you, Mr. Chairman, and appreciate you all for being here. I'm going to limit my time just because I want Mr. Gabarino to have time here, knowing that we've got a stop here. So I want to jump right in it to Chairman Hill. Does the FDIC currently have the data necessary to accurately target and effectively implement any of the current deposit insurance reform proposals?
I'd quickly make a couple of points. I'd first say we do not have granular deposit data on that would inform us on how many deposits are above or below certain thresholds above the $250,000 limit. That being said, I think under any circumstance, even if we had perfect data, any projections we would make would still have uncertainty because what we would not know is to what extent deposits would potentially move either from interest-bearing accounts to non-interest-bearing, from banks that potentially have access to the expanded coverage from those that don't. So I think there's going to be uncertainty no matter what.
Let me jump in here real quick. You can maybe even finish that thought. But when you appeared before the Senate Banking Committee, you shared your views with Senator Alsobrooks that raising deposit insurance coverage would not significantly increase assessment costs for banks, despite also saying that necessary data wasn't there and unnecessary depositor behavior could shift things. Can you share how you came to the conclusion that banks' assessments wouldn't rise?
Sure. The position that I've taken is it is possible that we might not need to raise assessments based on the way that the Haggerty-Alsobrooks bill is structured. The way that they do it is they would have the increase in deposits phased into the reserve ratio over a 10-year period. And so I think when we think about the costs, there's a couple of elements to it. One is the mechanical piece, which is what is the technical impact on the reserve ratio? And based on the projections that we have, which again are subject to significant uncertainty due to data limitations and also just potential behavioral changes that could occur. But the projections we have suggest that it might be the case that the reserve ratio would grow more slowly rather than decline. Then there's the other piece of it, which is the more fundamental piece, which is to what extent does this increase the exposure of the deposit insurance fund over the long term? Mm-hmm. And I think that is also something where there are considerations on both sides of it. The FDIC is not a typical insurance company in the sense that when banks fail, we rarely pay insured deposits. Usually we resolve failed banks by essentially selling the failed institution to the highest bidder. And insured deposits, in particular non-interest-bearing insured deposits, tend to have a lot of value to potential acquirers. So increasing the amount of insured non-interest-bearing transaction accounts could increase the value of those failed institutions, which potentially could bring costs down. The flip side to that is effectively you're increasing the cost of liquidation. So if you don't have an acquirer, the sort of tail risk of the maximum amount the FDIC might pay will go up. So those are a couple of the main considerations. But again, I think it's going to be a complicated thing to project out. But I think there's at least some justification to not raising assessments if the reserve ratio did not decline.
Okay, thank you. I'm going to yield back the balance of my time.
The gentleman yields, and just for situational awareness, we're going to recognize the gentlewoman from Georgia, and then Mr. Garbarino from New York, and then we're going to adjourn. So now the gentlewoman from Georgia, Ms. Williams, is recognized for 5 minutes.
Thank you, and thank you, Chairman Hill and Ranking Member Waters, for holding this hearing. Y'all, I represent Atlanta, which has one of the largest racial wealth gaps in the country. And I was proud of our regulators' commitment to fostering inclusive economic growth and resilience, not only in Atlanta, but in communities across our nation during the previous administration. Regrettably, the strides that we've made are now in jeopardy. Last year, when we met with our prudential regulators, many of my Democratic colleagues reiterated one thing: implementing a Project 2025 agenda in the financial service space means risking our economy, favoring billionaires, and advancing priorities that will systemically hurt millions of Americans in the middle class or worse. Basically, it's exactly what you guys said. We shouldn't be weaponizing our financial systems. Fast forward, and our current president has so far acted in line with those same exact Project 2025 recommendations, eliminating key agencies or virtually eliminating key agencies, or drastically reducing things like the CFPB and the Minority Business Development Agency. So far, most of the president's actions have been devastating to marginalized communities across the country, particularly impacting economic mobility. Even worse is the president's attempt to undermine and influence our prudential regulators who are meant to be independent. Earlier this year, I joined with my colleagues, Congressman Emanuel Cleaver and Congressman David Scott, and sent a letter to the FDIC, to you, Mr. Hill, and voicing our concerns over DOJ's attempt to fire employees and merging the FDIC with other banking regulators. We never heard a response. But since we didn't hear a response and we have you here before us today, I am going to ask you a few of those questions that were in that letter. And Mr. Chairman, I'd like to ask for unanimous consent to insert the letter that we sent on March 28th for the record.
Without objection.
Chair Hill, my district is home to FDIC's Atlanta Regional Office. Earlier this Congress, there were reports that over 700 workers were fired or forced to accept buyouts, while 170 probationary employees were terminated without recourse. Can you provide an update on the status of those employees that were shuttered from work, and can you share how many employees were impacted in the Atlanta Regional Office?
Congresswoman, I'd have to get back to you on specific numbers. It is certainly not true that 700 employees were fired. That definitely did not happen. I also we certainly try to respond to all letters that we receive questions, and so if you did not get a response, then I want to apologize for that, and we will make sure to respond to any questions that you've sent us.
So we've submitted all of the questions for the record, and I do hope that I get a response. And I figured you would not have an answer today, but since you've had since March 28th, it's unfortunate that I still can't get answers to those questions. Mr. Hill, I understand that you're serving as the acting chair, serving on the board with prior FDIC experience, so I imagine that you know a little bit about how important the work of FDIC staff and their examiners are. Speaking from your experience, what would be the consequences of the FDIC not having enough experienced examiners and managers? What would be the consequences of not having enough staff to conduct oversight, which is a key role in this position?
Certainly agree with that. Having qualified and experienced safety and soundness examiners is core to one of our primary missions, which is promoting the safety and soundness of financial institutions that we supervise. And so we very much value the experienced workforce that we have. And as I mentioned to one of the Congresswomen earlier, we are taking a number of steps to try to ensure that we are able to retain our experienced examiners.
FDIC independence, as you know, ensures that banks remain financially strong and continue serving the communities that many constituents and minority-owned businesses rely on. Some of my colleagues on the other side may make it about politics, but ensuring that the FDIC has the staff capacity to supervise 4,000 community banks seems like good policy to me, not just politics. Another issue my colleagues and I have concerns with are the reports alleging that the administration has looked into ways to influence the FDIC behind the scenes, including through unprecedented involvement by the White House. And with the CFPB being gutted, attempts to fire Democratic board members at NCUA and the Fed, it's clear that the Trump administration wants to influence our banking regulators with his policy. Mr. Hill, have you heard discussions recently on the White House being involved with the rulemaking process?
We have a process for issuing our rules. We have a board. It goes through our board process. We do coordinate with other agencies as appropriate, and that's something we continue to do.
Mr. Hill, I have many more questions in the letter and that I have evolved since March 28th.
gentlewoman's
and I will
time has
submit
expired.
them all, and I really would appreciate a response. Thank you, Mr. Chairman. I yield back.
The gentleman yields back. The gentleman from New York, Mr. Garbarino, is now recognized for 5 minutes.
Thank you, Mr. Chairman. Thank you all the witnesses for being here today. It's almost over for you all. I'm going to go quick. Ms. Bowman, your predecessor had a lot of bad ideas and proposals that I'm thankfully for our economy. Those changes were not finalized. One of I want to talk about is the mathematical function that determines capital requirements for securitization exposures, known as the P factor or penalty factor. Your predecessor proposed doubling this surcharge from 50% to 100%, even though he had no data or analysis to support it. And some would say the existing P factor is intentionally highly punitive towards securitization. I asked Chairman Powell when he was here about this and whether or not they would consider changing it. He was unable to give me an answer when he was here back in February. So rather than rubber stamping the Biden era P factor rate, will you commit to revisiting the P factor for securitization by examining the data, quantitative analysis, and impacts on consumers through the cost and availability of credit for U.S. households and businesses?
I can assure you that we are taking a completely fresh look at our responsibilities to implement the Basel III framework, and that we are reviewing all of the comments that were received. There were hundreds of comments, and that we will be reflecting many of those in that proposal. And I'd be happy to review the issue that you've raised. We want to make sure that there is empirical evidence that supports the issues that, or the calibrations and the factors that are included within the capital framework.
I appreciate that answer, and I really do thank you for your continued work on the Basel reproposal. And I want to switch gears just a little bit, talking about the Basel reproposal. I want to encourage you to look at, carefully consider the impact of foreign banking organizations and the way what the role they play in the U.S. financial services industry, specifically in New York, which I represent, has over, I believe, 200,000 employees of FBOs. And I just want a commitment also that your REIT proposal will take into account the business models of foreign banks and also appropriately align the actual risks, operational and otherwise, posed by FBOs.
I appreciate you raising that issue, and yes, it's definitely something that we are reviewing and considering.
I appreciate that, and I'm going to yield real quick so we can ask a question to my colleague from Nebraska, Mr. Flett.
I thank the gentleman from New York for the opportunity. I'll be brief. On October 7th, the OCC and the FDIC published a notice of proposed rulemaking where you were defining quote-unquote unsafe or unsound practice under Section 8 of the FDIC Act. And Comptroller Gould, let's start with you. If the definition you have jointly proposed were in place in 2022, do you feel it would have changed the way examiners would have been looking at the Silicon Valley Bank before its demise?
I do. That level of embedded interest rate risk on that bank's balance sheet sure seems to me like a material financial risk.
Acting Chairman Hill.
I would agree. I think the SVB experience is one of the key inputs into the motivation to reorient our focus, and so the full intent would have been for the focus to have been different.
Additionally, as part of the OCC FDIC proposal, matters requiring attention, or MRAs, must be tied to circumstances posing material harm to the financial condition of the institution or a material risk of loss to the deposit insurance fund. Quickly, for both of you, I know you both feel strongly that this change will ensure the MRAs remain closely tethered to the types of material risks that are the core of safety and soundness. How do you ensure this change doesn't go too far in tying the hands of examiners when they see genuine material problems within an institution?
Well, again, I think it ties them to material financial risks, which are the risks that we really can't afford to miss. But of course, supervisors have other tools available, including the ability to still cite banks for actual violations of law.
Chairman Hill.
We put a lot of thought into how the definitions were worded and how they were described in the preamble of the proposal. It's a proposal now. We are receiving comments. Look forward to getting the comments back. But we'll certainly want to make sure we are striking the right balance in whatever the final rule is.
Striking the right balance, I think, is important here. And with that, I thank the gentleman from New York. I yield back to him.
I also yield back to the chairman. Thank you all.
The gentleman yields. I'd like to thank all the witnesses for your testimony today. Without objection, all members will have 5 legislative days to submit additional written questions for the witnesses to the chair. The questions will be forwarded to the witnesses for their response. Witnesses, please respond no later than January 7th, 2026. We have another hearing in this room at 2 p.m., so we ask everyone to exit promptly after adjournment so we can prepare the room. And with that, this hearing is adjourned.